Alright, Chapter 9 Options. Equity options. Call. An option given an order right to buy stock at a fixed price anytime during the lifespan of the option. Put. An option given the holder the right to sell a stock fixed price at any turn during the lifespan of the option. Type. All listed options are either two types, puts or calls. Classes. Option, same type of the same underlying security. For example, IBM calls regardless of consumption month striking price form. IBM call class. Puts. IBM would thus a different class than IBM calls. Series. All options the same class, same strike price, same expiration month. For example, MSA April 5th, 50 calls for one series of MSA call class options. MSA April 60 calls for another. Holder or buyer, the purchaser of an open option position. Writer, the seller created of the option position, such as writer might also be said to be short on the option. Opening transaction, opening purchase created for the increased long position, opening sales created for the increased short position. Closing transaction, closing purchase, reduce, eliminate short positions, closing sale, reduce, eliminate long positions. If the client has no other position through bought one IBM January 120 call at 111, it would be open purchasing. Trading cycle. Each class is listed. Open option may trade only one of three cycles. Each cycle is distinguished by an expiration month. Cycles are occasionally referred to as the first month of each. Striking price, also termed exercise price per sheet. Share of the buyer would call agrees on the pay to the seller. There should be called exercise the price per share by the seller on put option agrees to pay buyer if exercise. Listed options standardized striking price is usually multiply 5 or 10 points. In the money on the current call, the current market price of the stock is higher than the striking price on a put. The current market price of the stock is lower than the striking price. Thus, IBM is trading at $98 per share. Of the IBM October 90 call would be in the money by 8 points. IBM July 100 put would also be in the money by 2 points. Determining which options are in the money, no consideration given the premium paid by the holder in the money does not mean the option is necessarily profitable to the holder at the point. Out of money, on a call, the current market price of the stock is lower than the striking price. On a put, the current market price of the stock is higher than the striking price. The XRS trading at $35 per share. XRX April 40th. April 40 calls out the money by 5 points. Although neither of these options have an intrinsic value, they still command a premium based on the amount of the time remaining until expiration. Intrinsic value, the option of the money. Intrinsic value of the difference between the market price of the stock and the exercise price of the option. For example, the BLY stock is at 43. The intrinsic value of the BLY August 35 calls at 800 regardless of the actual market price of the option out of the money option. Therefore, no intrinsic value. Premium amount of the buyer option pays the seller for the option. In other words, the options marketplace for the purpose of exam continue advising use of the premium. The definition: aggregated exercise price, striking price of the option times number of the share of the contract, normally 100, though not always. The aggregated exercise price for the April 80 calls at $8,000. Open interest. Total number of the contracts of the given class series per capable of being offset of the closing transaction. In other words, either with the total number of the outstanding short position, total number of the outstanding long position, not the total of both open and interest of the given series by 0, but it may be 2,000 depending on the activity and popularity of underlying stock. There's no limiting opening interest of the number of shares outstanding. Spread simultaneous long short position of the different series of the same class. For instance, long as 1 DDD April 35 call and short 1 DD April 40 call. Straddle a put and a call. Either both are long or both long or both short on the same stock with the same exercise price and same expiration month. For example, long one NMO June 40th call, long one NMO June 40 put. Put and a call either both belong and both short or same stock with either different exercise price for the different expiration months. For example, the one Exxon October 30th call along Exxon October 35 put. Note in the example of travel, the combination may use the long position should the investor subscribe seller options rather than go long buy. The position created would be short straddle and short combination. Covered. Calls are covered with a short option position protected with a simultaneously long position, 1 underlying stock, 2 convertible security, 3 escrow receipt, 4 warrant plus any cash necessary for the exercise, 5 a call with an equal low striking price, expiration date no sooner than the short option. Puts are covered when only when account is in a long put with a striking price equal to or higher than the short put, expiration date no sooner than those short option put writer is not considered in it covered if he's short underlying stock. Uncovered or naked. This position is where the buyer or the seller have the underlying position described above. Covered and naked options very risky. However, they are maybe very profitable. Underlying stock indexes move the investor anticipated profit can be high because of the investor would only have to put down a small amount of money. On the other hand, if the stock index moves the other way, seller naked option could suffer large losses. Uses of options. A number of the questions will be asked the various option strategies. Some questions deal with the break and even points of expiration of the option. Thus, the option any related stock position were liquidated immediately prior to expiration. At which point there would be transaction net out to zero profit loss. Further questions may ask the maximum profit loss possible from a given position. Commission may be ignored for all questions in the exam. Long option positions. Long option positions maximum possible. Loss of the amount paid for the premium for maximum profit long put with the difference between zero and the aggregated exercise price of the put, less the premium paid, the maximum profit of the long call position can be computed. Call purchases, break-even point, striking players, premium paid. For example, the investor 1 HOI March 30th call, March 30 call at 300 breaks even at 33 option where exercise 30 stock acquired would be sold immediately at 33. The 300 profit would exactly offset with the cost of the call and lower stock price on the expiration would show loss, and stock price higher than 33 would represent the profit of the holder. A put purchase breaking the point of the striking price and less than premium paid. For example, the investor 1 DEC April 110 bought put at $700, breaks even the market price of the DEC at 103, stock purchase at 103, put the writer at 110, would exactly recapture the $700 premium price. Long straddle, break even points, striking points, plus the combined premium of the upside striking price minimizes minus the combined premiums of the downside. For example, the investor 1 KO April 65 calls 400 and 1 KO April 65 calls put at 200. Expiration KO must be higher than 71 or 65 plus 6 or lower than 59, 65 minus 6. Net profit to be when they realize. Naturally, the market might move far enough to both directions, both sides of the B exercise closed on profitability with the expiration previously on exercise straddle. Must have one side of the money while the other side is in the money, excluding the possibility of certain not strong the shot closes pricely on the striking price. Long combination, breaking even points of calling straight plus the combined premiums of the upside of the putting the striking price combined premium the downside. For example, the investor 1 cat July 80 put at 100, 1 cat July 90 calls at 350. At the expiration, cat must be higher than 94.5, lower than 75.5 for the net profit to be realized. Total premiums is cost of $445. With a put exercise at 80 would break even. The stock price were 70 at 5.5, buying at 75.5, put at 80 is $450 profit. Breaking even on the call would occur in the stock were trading at 94.5, calling 90 would sell at 94.5 with a profit $450. Alright, short option position rating strategy. The difference of the underlying strategy for the position must be evaluated with a conjunction of long short position underlying stock with the writer may be compelled with the purchase or sell. When calculating break-evens on the covered calls, assume the investor sells the stock upon expiration of the option, although they may happen infrequently in the real world. Basic writing strategy: sell a covered call at the money, breaking even the acquisition cost of the stock less than the premium received. The maximum profit is the premium. For example, the investor buys 100 BA at 50, simultaneously selling 1 BA May 50 call at 550, breaking even at 44.5, maximum profit $550. $550 protects the stock bought at $50 should the investor be forced to sell the position at 44.5. Loss of stock is equal to premium received. However, the should stock rise, let's say $60, he would be called $50 of the cost of the stock, and his profit would be limited to the $550 premium. Or sell it covered called out of the money, breaking point with the acquisition of the stock less than premium, the maximum profit, the premium price plus the money amount. For example, the investor 100 buys 100 EK at 34, sells 100 EK in October at 40, calls for $300. Break even point 31, maximum profit 91. This is the option whether they exercise any price higher than 40, leaving the investor $600 profit for the purchase sale of the stock at 34 to 40 points, plus $300 premium. Sell a covered call in the money, breaking even point with the acquisition stock with a premium to maximum profit of the option premium less intrinsic value upon establishment of the position. For example, the investor buys 100 MCD at 58, simultaneously selling 1 MCD July 50, calling for 1,000, breaking even at 48, 58, and minus 10. Maximum profit $200, $1,000 premium loss, $800 loss stock position, which is intrinsic value. You go with the call. Sell a naked call, break an even strike price, premium to receive the maximum profit of the business, maybe the maximum losses unlimited. For example, the non-stock position investor 1 EK August 35 call at 250 EK stock at 33.5, breaking even at 37.5. There will be a loss above this price potential unlimited maximum profit $250. Realize EK stock is 35 or below upon expiration option. Selling a naked put, breaking even the striking price of the premium to receive the maximum profit of the premium, the maximum level of the difference between aggregated exercise price of the less than the medium premium and zero. For example, the investor sells 1 HOM August 100 put $950, breaking in at 90.5, maximum profit of $950. HOM above 100 at expiration. The exercise HMO purchase 90.5. 100 exercise price at 90.5 premium received, thus $9,050 maximum possible loss. No, investors who felt that the market was about to rise could use the option in one of the two ways. One, in the long calls, two, in short puts. For instance, the investor feeling that IBM trading at $90 per share was about to rise might go long buy IBM October 90 and call at $6. Once IBM rose above 96 per share, he would begin to profit. He might also sell IBM 90 put at 5. Should the IBM above 90, the owner that put the delivery stock to him at $90, it could be sold for more than the open market, and he would profit the remaining $500. An investor who felt the market was about to go down has two strategies available: one, go long puts, and two, go short puts. Go long puts and two short calls. For example, the investor feeling Danaher Corp trading at $110 per share was falling and the price could go long buy DHR April at 110 puts at $4. Once DHR drops to 106 per share, he will profit by buying stock perhaps 102, exercising 110 at a put. After subtracting $4 cost of the put, he will still have $4 profit per share. He might also sell short DHR April 110 calls at $7. Should DHR be below 110 at the expiration, the call would not be exercised with the profits remaining at $700 premium. From a standing market direction, he begins long calls equivalent to being short puts, rising market long, and being long puts, and the same as being short cuts, declining market. Alright, spreads. Spreads refer to the difference premium to pay for the receiver to simultaneously purchase sale of two or more series of the same class option. The spread hopes that difference with either widen or narrow the stock price fluctuate with the options approach expiration. In other words, spread goals is to make money on one side faster than loss on the other. Simultaneous long short positions reduce the risk of the pure long and short positions, but at the same time precludes the larger profit potential associated in such positions. While the numerous variations must spread with the categories established either with the credits or debit, the credit spread of the option sold produces premium cost for the option purchased. A debit spread of the option purchase costs more than premium received in the option sold. Credit spread are profitable when the spread narrows on the both sides of the expired unexercised. Debit spreads are profitable when the spread widens and both sides may be exercised. Sample 1, called bull spread. They are referred to as money vertical or even rarely perpendicular. An investor buys 1 XOM in April 60 at $800, sells 1 XOM at April 70, calls it 400. XOM stock is 64. The maximum profit of the XMO is 70. Any higher price of the price spreads would widen 1,000 long. April 60 would be it costs $8. $800 could be closed at 1,000 for a profit of $200 profit. Short with April 70, however, the would expire with $100 profit. Each leg with a spread therefore contributes to the total profit of $600. Note that the spread cannot be produced more profit than $600 because at every point XOM rises above 70 produces a point loss, produced profit on the 70 call. Alright. raising each additional point with a profit on 60 call. The maximum profit with the difference between the striking price and the less debit. Maximum possible less of $400 debit would be occurred with the XOM were below 60 at expiration. Then both options would expire worthless and $800 loss of long option partially offset by a $400 profit expired short option. Example 2, the call bear spread. Had the spread been bearish, XOM taking the opposite side of the market, the sold of the April 60 call, bought at April 70 call, $400 credit would be resulted. Stock then fell below 60. Both options would have been expired, worthless, and spread would have been narrowed and possible zero. Therefore, initial credit of $400, maximum profit. Maximum loss of spread widened across the investors would have the difference between striking price and less the credit. Or at example 3, put horizontal spread. This is called the time spread. The investor buys one APD October 50, puts at 500, sells APD July and puts at 400. Striking price same, must be intrinsic value. However, the October 50 put premium greater than that for the July 50. And July 50 because of the 90-day longer life. As July approaches July 50 will begin to lose any time value that it has. An option will revert intrinsic value. Indeed, it has any. October 50 put, however, stays at 90 days to run. Premium should no contract as much. Hence, APD were 400 upon expiration. July 50 put could be closed at 200, yet yielding $200 profit. Opening sale of 400. October 50 put, of course, would also be intrinsic value of 200, might be priced at 400 because of the potential appreciation over the remaining 90 days of its life. If so, it could be closed out about for the price for leaving $100 less on the cost of 500. Spread of as a whole, whether it had been profitable, widening out with the initial premium, the difference of 100, 500 versus 400, the closing difference of 200, 400 versus 200. In terms of vertical and horizontal income in the system, the newspapers once and listing options activity. Horizontal spread the different expiration months and the months were listed across the paper. Vertical spread the different striking prices were listed with the top to bottom in the press. Hard taxation. Long options. Opening purchase for the closing sale of the taxable result with a capital gain or loss. For example, February 22nd, 2008, investor buys one GWW for April 60 calls, 450 sells at 700. March 31st, 2008, result of a $250 gain. The expiration, either long over the long put or long call, is treated as a closing sale with no consideration expiration date. Hence, the entire premium as capital is lost. The exercise of the long call option represents the purchase of the underlying security. The premium pays the aid for the aggregated escrow. Exercise price of the option, which is the price paid for the stock, with established for the cost paid for the stock, with the holding period commences on the day of the exercise, with the holding period over the option irrelevant. For example, January 24, 2008, an investor buys one ABM, May 15th, calls it 275, exercises the option April 15th. Investor has purchased 100 ABM at April 15, 2008 for $1,775 and $1,500 exercise price, $275 premium. The exercise of put option, on the other hand, resolved the sales security. In this case, the premium is subtracted the aggregated price for the option to determine the selling price for the stock. Price is compared to acquisition cost of the stock put. The writer to determine the extent of the profit or loss realized. Holding period is based upon when the date of the stock was originally purchased. The date of the put was exercised. For example, June 18, 2007, investor buys one XCX October 30th, put at $150. September 9th, 2007, puts exercise investor delivers 100 CX originally purchased at May 3rd, 1995 for $2,600 with the result of $275 capital gain. $3,000 minus $2,600 equals $400 minus $125, $275. Note that the acquisition put against the long position stock and canceled with the holding period for any stock not already holding. Long-term holding period of the stock commences, again eliminating put position. Short option. Open sales are filed with the closing purchase of the taxable results, always capital gain or loss, never ordinary income loss. For example, the June 10, 2007, investor sells one SGP with the August 40th inputs over the $550 and August 5th, 2007, buys it back at $250, resulting in $300 capital gain. The expiration of either short put with a short call is treated with the closing purchase note, but the consideration has been made at expiration date, hence the entire premium is capital gain. Exercise short call result of the sale of the underlying security by the writer. The premium received is at the aggregated exercise price for the option determined the sales proceed with the exercise date with the share of the sale date. Cost based the actual handling period of stock delivered to determine the nature, extent of the gain and loss. For example, February 15, 2007, the investor wrote 1 TFX, October 45. Call at 1,000 and March 28, 2007. The investor received the exercise notice delivered to TXFX stock originally purchased at 2,900 in 1962. Thus, the investor relieves $2,600 capital gain. Exercise short option result of the purchase stock by the writer. This devoid of tax solution consequences until the security is actually sold. Writer subtracts the premiums. Receive the aggregated exercise determine the cost basis of the stock, the holding period of the stock, commence of the put's exercise date. For example, April 18, 2007, the investor writes 1 TXF, June 45 puts $4,500 on June 2nd, 2007, must be exercised. The investor applied the 100 TXF, the $4,000 with holding period starting at June 2nd, 2007. Alright, summary of key date and times. Hours of trading 8:30 to 3:10 p.m. Central Time, except for the business day prior to expiration with a trading sense of $3, 3 p.m. Central Time. Premium to due clearance corporation 9 a.m. Central Time business day following the report match trade. Normally match trades are reported trade day with a premium due next business day following the trade. Options and issue the transaction effective with normally Central Time business day after the trade the day that's above. Exercise cutoff time 4:30 Central Time on the business day prior to expiration. Customer must notify broker carrying out the intent of the exercise prior to the time option will expire. Exercise notes acceptable to the clearing corporation other than last day training 9 a.m. to 3:30 p.m. Central Time. Note that the cutoff time is 1 hour later, but only business days prior to the expiration. Exercise statement date, settlement date noon Central Time. On third business day following the date of the exercise notice tendered in the clearing corporation. Exercise expiration 10:59 p.m. Central Time on Saturday following the third Friday of the expiration of the month. Alright, LEAPS, Long-Term Equity Anticipation Securities. This listing equity option exchange began in early 1977 at the time of the increasing number of strategies that employ the product have been developed. In addition, when the created bullish, bearish, and neutral positions, options can be used with protecting existing long and short positions. On drawback, use of options have been limited life in the past. Exchange limited listed options that approximately maximize 9 months from then until the expiration of time. Factor increase the risk of the option holder because with each ticket of the clock portion of the options value vanished. The negative aspect reduced to some degree in the 1992 Security Exchange approved the list of the options as to which with as much as 39 months of life before expiration referred to as long-term equity anticipation securities. Long-term equity anticipation securities are LEAPs, similar to traditional share options or trading methods. Strategic applications, although increased time factor does not allow some of the expanded use. LEAPs are available to both puts and calls, allow investors to protect against decline stock and take advantage upward move of the extended period. They are, I gotta read. More closely related to actual position underlying security shorter options extended by the LEAPs will command with a greater premium and the similar to the option with a less duration, but the cost will still only be the fraction amount required for the purchase of the underlying security. For example, Yahoo stock trading at $50 a share purchase of 100 shares would cost $5,000. Same time, 50 Yahoo calls for the 2 months of the until the express rate available the premium of $4.60, $460. However, Yahoo 45 LEAPs with 2 years until the expiration commanded with a premium of $10.20 or $1,000 in 2010. $20 purchase the LEAPs would give the holder a call on the stock within nearly 2 years after the price less than 20% above the current market price. LEAPs are traded in American style. This is holder that has the right to exercise the time prior to expiration. Leaps offer certain strategic advantage if they cannot be considered equivalent position underlying stock, but although issued with longer duration, they are due in time expire. Their continuing erosion of the option premium works against the holder with the additional factor of the investor consider the option holders do not receive any dividends. While stockholders generally do receive quarterly payments, the leaps can be found on the financial page each day in May 2004 following listing period. The listing provided with a complete description of the previous day trading underlying stock of the Yahoo, the expiration month and year of the January 2005 strike price 45, typical option information, trading volume, and the last sale was provided. Although all usual strategies available to leave long-short positions can be established even in shorter contract straddle spreads also be created. The only distinguishing feature of the leaps of the time factor investors must weigh the advantage of the leaps up over the using short option, roll them over the each expiration approach. Options that are not suitable for the investor graded care must be exercised before recommending their use. Specify the leaps trading as follows. Effective January 2005, the Security Exchange Commission approved 25% loan value, but the current market value listed above options have long life, more than 9 months. The over-the-counter options loan value 25% in the money or intrinsic value. Consequently, both listed over-the-counter options go to the point that their lives are less than 9 months. No loan may be extended. Alright, adjustment of the contract terms. Significant difference between listed and unlisted options. Effect of the cash dividends of the exercise price, the striking price, the eventual option of normal marketing price. Underlying stock time sales should be stocked and go extended dividend striking price. Reduce the exact amount of cash dividend. For example, 95 days of KWR at $25.62.5. The striking price at KWR goes up to 44 cents cash dividend, but the striking price was reduced at $25.185. Therefore, should the call exercise over the coverage call writer loss for the dividend from the lower proceeds. On the other hand, the listed option striking price does not reduce the cash dividends, and covered call writers retain all the dividends of the stock unless the call holder submits an exercise notice for the clearing corporation prior to the dividend date. With the increase of the proof of the covered writing, especially relative to the high-yielding, low-volatile stocks, typically do not command larger premiums. Public utilities. Stock dividend splits, rights offering spin-offs, however, they do not cause adjustments. Listed option contract distribution results less than one new share of the outstanding share. The number of shares per contract increased the amount, but the new amount of shares striking price is lowered accordingly. If the distribution results in one or more new shares, outstanding share, new contracts issued for 100 shares each for the new strike price. For example, SDI goes to X 6% stock dividend. SDI March 80 calls adjusted to 106 shares, striking price at 75.5. New striking price is 75.47. The final with the dividend. Old aggregated exercise price 8,000. New number of shares 106. Rounding the near 16th. Not necessarily the next higher, but the other X dividend reductions. On the other example, CME splits 4 for 1. CME July 120 put would put adjusted 4 CM July 30 puts at 100 shares each. Right offerings for the other non-cash distributions usually result in the reduction in striking price and no additional share per contract. Clearing corporation reserve the right to make whatever adjustments fair and equitable. No premiums are quoted in price per share. The investors typically make automatically mental adjustment multiplying given quotations 100 to find the cost of the option. For the instant of the quote shows UN July 60 calls at 2.5, meaning that it would have been bought or sold at $250. However, the UN had split 3 for 2 to pay the 50% stock dividend. This result adjusted 150 shares UN July 40 call on the contract quotation at 2.5 would represent 375. Note $250, 150 shares times $2.50 per adjusted contract. Alright, floor procedures. AMX and CBO floor procedures have some marked differences on the exam. Careful note of the exchange particular question refer as the instance. CBO limits orders placed on the book. Specialist order book official market writer registered marker. Answer B is correct. Order book official for the same question placed on the AMX would have been answered A. Order the book official of the CBO members who is charged with handling the book, opening orders, specific class options, except the public orders only, may not accept orders or spread straddles or proprietary accounts, market makers, contingencies, including stop or stop limits. You may this only enter limited market order on the books, makes no principal trade. Market maker, CBO member register to make competitive bids for the offer of the specific class for the options intention to increase liquidity does not have any of the book function. Floor broker, CBOE member handles the public order as only an agent, frequently as registered of the market maker by any act. Only one of the capacity is given the day of the particular stock. Specialist A, American Stock Exchange member has both book and principal function, particular option calls class. Registered option trader of the American Exchange member, functional similar to the CBO market maker, trading rotation. Brief period during the bids when the offer is accepted, but only on specific series of the per class. The order books official start with the next expiration month, lowest striking price, calls highest striking price, puts opening the various series of sequence proceedings of the next expiration month. Process is repeated until all series are open and used on openings other times if deemed necessary on the fair equitable market. Accommodation, liquidations, cabinet trades, a worthless option may be liquidated by placing an order to sell at a cent per share with an order book. Official execution produces confirmation showing liquidation gross sum of the dollar, which sometimes useful for the tax records. Off the floor transaction only permissible where the member has the attempt to execute. The floor has a reasonable certain that a better price may be obtained off the floor. Or options clearing corporation signing exercise notes. Option clearing corporation signs exercise notice tendering to the random selection based exercise occurs if the notes involve the block size 25 or more contracts. In this case, option clearing corporation will attempt to assign with such notes the member account short an equal number of the contracts in order to produce the clearance of minimum. Note choosing the customer allocated to the exercise note member may form the FIO. First in, first out means the oldest, shortest exercise first. Issuing with options clearing corporation, not exchange, not the exchange, also not the writer, but the issue of the listed option. Option is issued at noon Central Time on the business day following the trade date. Summary of the key dates and time reports. Reports at 9 a.m. Central Time. The Operation Clearinghouse reports daily with the position all exchange transaction member accounts settled with the day with the net premium day due to the member of the office open clearinghouse corporation, including open and closing exercise transactions. Margin, the margin required of the day, all short position contracts exercised with the account member, the senior registered option trader delegated, most likely daily review of these option reports. Automatic exercise of the open clearing option clearinghouse corporation will automatically exit a long position with an expiration in the money by 3/4 of a point customer account and 1/4 point firm account. Regulations, supervision, customer account, new account data member opening an account with a new customer must obtain the record following the day with a new account. Investment objective, totally estimated annual income, estimated liquidated net worth, age, marital status, number of dependents, previous security investment, and experience employment status. A copy of the completed document must be verified, signed, and returned to the customer within 15 days of approval of the account. Special options agreement. Within 15 days of the approval of the account with the option trading, the customer has signed with the return member of a special options agreement in which the customer agrees to buy the exchange of the open clearinghouse committee corporation rules. See position exercise limits. Statement account with the member must send to the customer statement account with the last quarterly account money security position the preceding quarter of each month, like all the accounts of the entirety of the preceding month. Customer statement that must include all the notice recommendations customers notified of the firm material change of the investment objective financial situations. Margin account must also market the value of each option security with the total market value of all securities and account margin equity. Total annual commission derived with the option transaction. Note if aggregated with the commission paid with the net, set forth the account statement, this must be set for the effect of the information with respect to commission and other charges incurred with the next execution option transaction has been included with the confirmation of the transaction previously furnished to the customer. The summary of this information will be made available to the customer promptly upon request. Records, all the documents discussed plus any of the option confirmation must be maintained with a minimum of 3 years. Branch office must also maintain own copies of such documents for the most recent 6 years. Approval actions. Approval of accounts. Prior to the transaction, new customer option account must be approved by the registered option principal that must author partner member. Each member must also qualify each member, branch officer, ROP, registered option principal. In addition, with every member of the senior registered option principal supervise all the customer accounts. Senior representative registered option principal must either general partnership or executive officer of the member. Also, each member must also have a compliance registered option principal who is responsible for the implementation and enforcement compliance policies. Discretionary account. The customer must first authorize discretion writing. The account must be approved with a written registered option principal, officer, or partner. And for every order with identified with the discretion approved the day of the entry, not necessarily prior entry, by an ROP. The account will then, subject to the frequent supervisor review, the member keep the records of the customer discretionary transaction, including customer name, Time of the day execution premium, the number of the transaction involved, judgment over the time of the price, not consider the discretion more orally delegated to the customer representative, registered representative. For example, the client calls a registered representative, tells them sell XONO calls, but watch the market. Maybe they will rally later today. Such an order would not require discretionary authority. The client had ordered the specific options sold, leaving only the time and the price execution of the registered representative. Sharing in the profits or loss. The New York Stock Exchange category prohibits sharing of the profit or loss between the customer and registered representative personally by the CBOE rules. Members of their employer, by the approval of such accounts in writing. Sharing agreement must be in writing, and the sharing agreement is proportional, not necessarily equal to each partner's equity naturally, whether they first belong to the CBO and the New York Stock Exchange. More strictly New York Stock Exchange rule applies. Suitability to become the new account with data specified above that every registered representative must have a reasonable ground for every recommendation made by the customer. In this case, the recommendation involving an uncovered call or put by the customer must reasonably be expected to make capable of evaluating the risks involved with a prudent and maximum 15 to 20% of the customer's investable assets may be committed to an option buying program. Positions limited to exercise limited. After effective with March 1985, position exercise limited for all options expanded in accordance with 3-tier increased above the security exchange. For the limits are 1 to 8,000 contracts, same side of the market, but the options underlying stocks meet either the following: trading volume of 30 million shares during the most recent 6 months period, a minimum of 120,000 shares outstanding, or had trading less than 40 million shares of the most recent 6 months in trading period, regarded the total number of shares outstanding. 2, 5,500 contracts, same side of the market. Of those options underlying the stocks meet each of the following tests: trading volume at least 15 million shares during the most recent 6-month trading period, the minimum of 40 million shares outstanding, or had a trading volume of 20 million shares during the most recent 6-month trading without regard to the number of shares outstanding. 3,000 contracts, the same side of the market of all the other options. The exchange of the review of the volume of outstanding share of the information underlying every stocks every 6 months will determine which limit apply with the acting in a concert may include an investment advisory registered representative with discretionary powers over the customer account, as well as banding together to exert manipulative pressures. No investor group of investor for acting concern may have the position excessive of the permitted amount of the same side of the market. Both sides of the market would be long call, short puts, bear side, long put, short call, with no combination of either the bull or bear position exceed the permitted amount. Any combination either side of the line may be equal to not exceed the permitted amount. Advertising sale literature. All options advertising amendment must first receive the approval of the CROP of the must submitted to the exchange of at least 10 days prior to the first use of the form of the media, including radio, television, telephone recording, constitute advertising copies may be retained for the firm at least 3 years. In general, advertising sales literature may contain untrue and misleading fact statements, omission of the material fact promise, specific result, illegal disclaimer, hedge clauses, exaggerated statements. For example, all our clients made fortunes last year. Overpromise and promissory statements. You can't lose if you follow your system. Flamboyant statements. You can't do anything wrong. In short, advising sales literature should meet the high standard of the good taste influences. And then we'll cut the tape there at index options.